So far in this track, we've been talking about one trade at a time. One entry, one stop, one target. But real trading doesn't happen one trade at a time. It happens 5, 10, sometimes 20 positions at once. Managing one trade is easy. Managing 10 at once is where most traders break. Because the risks that sink an account are rarely in the individual trade. They're hiding in how the trades combine. This video covers 3 ideas that lie above the single trade: portfolio heat, correlation, and the line that stops the whole book when the day turns bad. The first idea is portfolio heat, one number that tells you how much total risk is open across everything you're holding. Portfolio heat is the sum of the risk on every open position, every 1R you've defined, added together. Recall from last video, 1R is the dollar risk on a single trade, entry minus stop times share count. If you're risking 1% on each of 5 trades, your portfolio heat is 5%. 5 Rs open at the same time. Risk 2% on each of 5 trades, and heat climbs to 10%. The same per trade rule now has your whole account exposed at 10% if everything hits its stop on the same day. Heat is the thermometer for the whole book, cool when you're lightly exposed, hot when too many positions are open at once. Collapsing everything into one number matters because you can't manage what you can't see. 5 separate risk limits is noise. 1 heat reading is a signal. But heat alone doesn't tell you the whole story, because not all open positions are actually independent. Here's the next idea: correlation. Imagine your 5 open positions are all technology stocks. A chip maker, a cloud company, a software platform, a semiconductor equipment name, an AI infrastructure name. On the surface, 5 different companies, 5 different tickers looks diversified. But when the market turns against technology, a Fed policy shift, a rotation out of growth, an earnings miss from the sector leader, all 5 of those names tend to move down together. 5 positions, 1 underlying bet. You don't have 5 trades, you have 1 trade wearing 5 costumes. This is why heat alone can be misleading. 5% heat spread across 5 uncorrelated trades is very different from 5% heat across 5 positions that all move together. Diversification isn't how many tickers you hold. It's how independent the outcomes actually are. The fix is simple. Put caps on the other 2 dimensions. Heat doesn't see how many positions at once and how much in any one sector. 2 caps follow naturally from the correlation problem. First, a cap on the total number of concurrent positions, a ceiling on how many open trades you're willing to manage at once. The reason is human, not mathematical. Past a certain point, you can't watch every chart, you can't track every stop, and the quality of your attention on each trade drops. Second, a cap on any single sector's weight. Even if you stop at 5 positions total, having all 5 in technology is still the 5 costumes problem. The sector cap forces the book to spread across different drivers. A name or 2 in tech, a name in industrials, a name in healthcare. Now a single sector reversal doesn't take the whole account. The specific numbers are personal. Some traders cap at 5 positions, some at 10. Some cap any sector at 20% of the book, some at 40. The discipline is having a number and respecting it. Heat tells you how much, the caps tell you how spread out. The last piece is what happens when the day turns bad. The last piece is a circuit breaker for the whole book. Some days the market just doesn't cooperate, every position goes against you, stops start hitting in sequence, the account starts bleeding. The worst thing a trader can do in that moment is try to trade their way out of it. Revenge trades, size-ups, chasing, this is where real damage happens. The circuit breaker is a pre-commitment, a line drawn before the bad day, not during it. The rule is simple. If the book is down a certain percentage on the day, you stop trading. Close screens, close platform, no new entries until tomorrow. It's the same logic as the per trade stop from video 3. There you pre-committed an exit for 1 trade. Here you pre-commit an exit for the whole day. The breaker works because it removes the one variable you can't trust in the middle of a losing streak: your own judgment in the heat of it. The trader who walks away at -3% on a Tuesday still has an account on Wednesday. The trader who doesn't usually doesn't. So where does the platform fit into all of this? ArcAlpha's job is what happens before an alert reaches you. Every alert has already passed its own quality checks. The analysis, the setup, the direction, the level structure is done by the time you see it. But portfolio choices belong to you. The platform doesn't know your book. 3 decisions sit on your side of the line. How many trades you're willing to carry at once. How much risk per trade, the 1% floor from video 1. And when a newer, better setup should replace a weaker open position you're already holding. That last one matters. A clean setup on your screen and a tired position you've been babysitting is not a case for 11 trades. It's a case for 10 by closing the tired one first. The platform does the per alert work. You do the portfolio level work. That isn't a limitation, that is the line we don't cross. ArcAlpha analyzes and alerts. You decide what the book looks like. So here is the frame. Portfolio heat is the thermometer, the sum of every open risk. Watch it at the book level, not the trade level. Correlation silently raises heat. Count caps and sector caps are how you keep the book actually diversified, not just spread across tickers. In the next video, we'll go one step further. When the whole book is leaning the same way and the market turns against you, the question becomes, can you hedge the exposure without closing every trade? This is educational content and is not a recommendation to buy or sell any security.